We are busy with exempt income, and I want us to get to, so here guys, this is what I was talking about. Gross income less exempt income gives you income. This, I always start with this tax framework to show you where something fit into it. Now we won't do a recap because I want to finish this chapter today. Yes, Tuesday we spoke about foreign dividends and all of this. And today we have to look at dividends paid as an annuity. So guys, Mrs. Apple, let's have a look at Mrs. Apple again. I recall some of you were asking questions about Mrs. Apple. So very important, guys, we will always give you the age of the person. Why? Because we have now seen with interest that we need the age of the person to know what exemption does this person qualify for, especially if it's a natural person. Please take note, this interest exemption is not applicable to companies. It's only applicable to natural persons. So that is the next thing that you need to look at. Is this a company or is it a natural person? Now, obviously, guys, if it says Mrs. Apple, then we know this is a natural person. South African dividends, South African interest, foreign dividends, foreign interest. Now, guys, I marked a few scripts. Big problem. I've penalized you. I was supposed to give you 0. People actually, I'm talking to you, just check your answer. People combine these dividends. You got 0. Sorry, foreign dividends. Guys, there's a huge difference between South African, which we often call local dividends, and then foreign dividends. And I don't know why people would do that, because the test paper didn't even combine them. How dare you decide that there should just be one line item? And that just shows that you don't understand the principle. You don't understand the treatment. Even when we dealt with special inclusions, there was always a part for local dividends, normal South African dividends, and there was room for foreign dividends. Because, guys, South African dividends, South African source, especially if you deal with a non-resident, but if that non-resident got foreign dividends, then we know we shouldn't even include it in that person's, in that non-resident's taxable income. So I don't know. I don't know why people just decided, let me put, and that will be the same for interest. I'm sure if I gave them foreign interest and local interest, guys, you never combine these things. Let me just say that again. You never combine. They need to be, there's a reason why they are actually showed. Interest to you might just be interest in tax. That is not the case. South African interest or local interest is different from foreign interest. In fact, in the test, I'm even going to give you interest from a tax-free investment. That is what I'll call it. Then you know the treatment is different. Remember, we spoke about tax-free investments and the limits on tax-free investments. Anyway, so calculate Mrs. Apple. Now, guys, with gross income, all those amounts, since she is a resident, she pays tax on a worldwide income. So all those amounts will be included in gross income. Now we need to look at exemptions. Now the South African dividends, full amount exempted. Why? Because there's actually dividends tax of 20%. South African interest, what will be exempted? So she's 68, 34,500 will be exempted. Then foreign dividends, and guys, this is something that I need to mention now. So guys, if we give it to you like this, we give it to you like this. Yes, there's a question.
Yes. Just as I was suggesting, I was also asking you a question yesterday in the last lecture based on essay interest, because I was comparing the last memo for the previous tests. I think there are two, but they're also giving the same answer. Like with referred to essay interest, for example, if a person is a resident, and now they receive interest, let's say interest from a local bank or from a resident, that SA interest, they say it's not part of gross income. But there, when you say it's part of gross income. That's why that's pushing, because they say the only interest that can be included in the gross income of a resident, maybe it's a resident, maybe from a foreign bank, maybe they invested outside. Yeah, yeah, like something like that. That's what I was asking, because I saw.
No problem. I can come in. Do you want to ask something else?
It's just that why is it included? Because I feel like it's from the, so that SA, maybe the interest is from the bank, local bank. It's from the source. That's why. That's what I thought, because when I was checking those things, those past memos, I thought that's why they related to that way. That's why they didn't include it. That's why.
But now the memo is guidance. You were supposed to inquire about that, because in my lecture under special inclusions, we said interest should be included for a resident. But let me tell you why that memo. It seems like it's an outdated question. And guys, that is why I don't want to share past papers, because for text things get outdated so fast. That is why you can't even use an old textbook. But let me tell you what happened. In the past, we were not required to include interest in gross income. The reason for that is because there was withholding tax on that interest. So what I've seen in calculations is people used to just say under gross income, interest, and that is what you saw there. Interest is not included because there's withholding tax applicable on it. However, in terms of Section 9, special inclusions, which is a new proviso that came a little later, it was actually now decided that in terms of special inclusions, interests have to be included in gross income, and then when we get to exemptions, you need to exempt the 23,800 and the 34,500. Then if it's foreign interest for a natural person, foreign interest fully included in gross income, and you don't even have any exemptions. And that is why, that is the risk of doing past papers, especially if they are not updated and all of that. So unfortunately, you will get all of that wrong, because you were supposed to stick to the notes and to inquire about that question. Is that fine, Silas?
It's fine, but is that interest from SA source? Since you say yes, resident tax on worldwide income, so yes, how so that is included?
So what is the SA? What is the SA source? Let's ask that first.
What is the SA source?
Yes.
It's whose finances based on the source, like based on
no. What does SA stand for? You don't know. See, you see
South Africa.
South African source.
Mm-hmm.
So when I say SA source, I'm just trying to tell you it's from a local bank. It is from South Africa. So that should actually give you, that should actually be very easy then. The reason why I say SA source or foreign source is for you to basically determine, should I include it and what will be the exemption? Is that okay, Silas? We will never get it wrong again, right?
That's why it's not specified. Okay.
Excuse me?
As I didn't specify, maybe it can just even just come from any place so long it's from the Republic.
No. If it's a local, if it's South African, then what I'm trying to tell you, and these are the small things that these things you should actually, that is how you attend the class, because sometimes on the slide, that is all what it will mean. But when we talk about SA source, that means it's local and you should include in gross income. That is just how it is. It's part of exam technique, and that is why it's so important to attend class. But guys, we are deviating from the real work. We haven't even started with our work yet for today. So there is the foreign dividends. Remember, for foreign dividends, we have to say 25 divided by 45, which is, I also gave you that formula since it's a natural person. Guys, something like this can count up to 3 marks. Why? I look at the dividend, I look at the formula, and I even look at what is the exempt amount. So from this 1,000, only 556 will be exempted. So what will actually be included is actually 1,000 minus 5556. So actually, what are we saying? 444 will actually still be taxable. And this, let's have a look at the next one. Foreign interest. Do you see? Foreign interest is not exempted because there is no rule. There's no exemption for foreign interest. So the full 200 is actually taxed. Let's go to the next one. Dividends paid as an annuity. Now, guys, sometimes you the company declare a dividend, let's say 1 million to you. Let's say you are the owner, a local company, and I just want to mention that again. And then they say, but listen here, we don't have cash resources now. Remember, guys, in accounting, this is probably the most difficult thing to teach people who don't, who haven't studied accounting. That we get an accounting profit and we get a cash profit, okay? Or, you know, and even taxable income. Because accounting profit, you guys know, we actually look at our, you know, our assets, revaluations, and all of these things. However, guys, you know, a lot of those things, you haven't sold them. You haven't sold them, okay? Yes, it's a profit, but we say it will be a profit if I actually sell, you know, some of these things, while a cash profit. So guys, what I'm trying to say is when you declare dividends, go check the cash flow statement. That is why it's so important to do the cash flow statement, because that is where the real cash is. That is where the cash profits actually lie. And that is actually where the dividends will be paid from. So I'm saying, then the company tell you, listen here, we don't have cash resources, or it's actually low, so we will pay that dividend as an annuity. We will pay that 1 million to you over 5 years, and we will give it you 200,000 a year. Then we say, actually, guys, it's not a dividend anymore. It has become an annuity. Now, the moment it is now, this dividend now become an annuity, then obviously you have to include it in gross income. And this is the exemption that is available to you. This section states that the section 10(1)H exemption in respect of interest and the section 10(1)K exemption in respect of dividends does not apply if the interest or dividends are paid to a person as an annuity. So guys, what I'm saying is, if this dividend become an annuity, those facts that I just mentioned, then you don't actually exempt the full dividend anymore, even if it's from a local source, but you will actually now use the annuity formula, y equals to A over B times C, that we will also look at a little later in this lecture. So very important, guys, read the information carefully. Yes, guys, it's easy to think, oh, dividend included in gross income, exempt it again. But read the facts. If this dividend, because in this case, you can clearly see this dividend actually becomes an annuity. Now, guys, sometimes it is us who have to advise our clients to say no to them. Say that you don't want to get the dividend as an annuity, because now you will only have the capital portion as an exemption, while if you got a dividend, you would have been exempted the full amount, and then you only paid 20% dividends tax. So this is where you come in to advise your client. And then, guys, if they don't have, obviously, if they don't have cash resources, you can always ask them to declare a dividend in specie. Now, a dividend in specie is basically them giving you an asset that also have the same value as that 1 million that I mentioned earlier. Now let's look at royalties paid to non-residents. Very important, guys. If it's paid to non-residents, for residents, royalties is just included in gross income. For non-residents, we say the full amount will be exempted. However, there will be withholding tax of 15%. So it will be exempted from our normal tax calculation if you look at your tax framework. But that is, and this is just the reason behind, or that you can actually have in the back of your mind. The reason why it's exempted is because there's another type of tax called withholding tax, and this is applicable to non-residents. Obviously, the royalty will not be exempted if that person, and if it's a natural person, was physically present in South Africa for more than 183 days in that year of assessment, or if that royalty amount comes from intellectual property that is connected to a permanent establishment in South Africa. And I already told you your permanent establishment, maybe you bought a house, yes, you are non-resident, but you bought a house in Camps Bay, a holiday house, also opened a branch, your company is international, let's say you've incorporated it in Australia, but you also opened a branch there in Camps Bay, and this intellectual property is now connected to that, to a permanent establishment. So guys, what we are trying to say is your business operations, your activities has become very, very permanent. Even though you don't want to admit it, then we say it's connected to a permanent establishment. Then section 10(1)(u), here we look at alimony and maintenance. Even this, guys, I could actually even ask you this in the test, because you know that we spoke about this. Yes, full amount will be included in gross income, but if you actually got divorced after 21 March 1962, then the full amount will be exempted. Now, obviously, guys, if you got divorced before 21 March 1962, and I'm not sure if these people are still alive, remember, for you to get divorced 21 March 1962, then it means you should have also at least been 20, 30 years where you got married, and even the years that you actually stayed with this person. So I don't think these people are still alive. But anyway, guys, then in a test, let me just get to that part. In a test, if we don't give you a date, you can always assume that obviously it is after 21 March 1962. All right. Then, guys, actually, I just remembered with this dividends, I want to go here. He actually interrupted me and I almost forgot about it. With the foreign dividends, remember we have the formula and then we have the full exemption. Let me go here quickly just to show you. And this is why I'm saying the formula and the participation exemption. Okay. Remember, for participation, you should at least have 10% equity shares. Now, guys, what I'm trying to say is that is why I'm saying you must attend class. If we just give it to you, foreign dividends 1,000, you can always assume that the person holds at least, no. If we don't give you that information, then obviously you need to use the formula. Okay, so no assumption. Sorry, I almost confused you there. No assumption there. We will, in a test, have to tell you that this is, or this person holds 12%, interest in this company, and then obviously, at least 10%. So obviously you will have to use the full amount will be exempted. However, if we don't give it to you, if we just give it to you like this, then obviously you need to use the formula. Obviously, you need to use the formula, which we saw is 25/45 or 8/28. However, if we tell you this person holds at least 10%, or if we say this person holds 6% equity shares, then obviously you also know that you need to stick with the formula, because this person does not at least hold 10%. Guys, what I'm trying to say is a person needs to hold 10% or more equity shares in a company in order for you to go with the participation exemption, which is actually the full amount will be exempted for foreign dividends. But if we just give it to you like this, we didn't tell you what is the percentage shareholding, automatically you have to use the formula. And even if I give you the total equity shares, let's say it's less than 10%, then obviously you also always need to go with the formula. Okay, I just needed to give you that again. Then subsidies, rebates and grants, and this is in paragraph 4.17. So any government grant or payment which is approved and identified by the minister will be exempted from normal tax. So guys, in a test, we will tell you that this is a grant or subsidy. Please don't make assumptions. Some of you even said for the gift, there was a gift in question 3 that someone got. And please don't you just decide that this is a grant and things like that. I've seen it in the past. People make their own assumptions, which is wrong. A gift is exactly that. It's a gift. It's a prize. It's a gift. So you cannot decide that that is now a grant. In fact, we will call it government grant or something like that in order for it to be exempted. Now, here are some of the programs that qualify for the exemption where people get subsidies, rebates, and grants. Programs for economic growth, employment creation, develop infrastructure, promote public health, develop technology, provide housing, and provide relief after natural disasters. We spoke about the government giving these subsidies to farmers, especially when there's drought, or even now that there are so many fires on the farms and things like that. So if the government actually gives subsidies, then that means that that amount will be exempted for tax purposes. Now let's look at section 10A, exempt annuities again. Now guys, we have covered this under special inclusions. We will just look at it again, and then there's a second part to annuities that we will look at again. Annuities are included in gross income in terms of paragraph A. That is now special inclusions. And then section 10A exempts a portion of the purchase annuity amount, but section 10A section 10A exemption only apply to individuals and special trusts, and the effect of section 10A is to divide the annuity into a capital portion and an income portion. So guys, Y equals to A over B times C. That is to get the capital portion, and obviously what remain is the income portion. Now we say the capital portion is the one that will be exempted. So here that information is again the capital element, the exempt portion is Y, and that is calculated A over B times C. A is the lump sum paid by the insured for the annuity, so what you purchase it for. B is the expected returns, and C is the amount of the annuity. And they say it can be expressed monthly, annually, or in total. Now, guys, be careful with this. Read your question properly in a test. Remember, in most cases, we are supposed to calculate someone's taxable income for a year. So obviously, then you have to. And very often we give you the monthly annuity, but if it's for a year now, remember that you now have to actually gross it up or something like that. All right, then a portion of the lump sum resulting from the commutation or termination of the annuity contract is also exempted. And this is the second part. So the first part, Y equals to A over B times C. Guys, now we have what will happen if I, let's say I go to Old Mutual and I say, listen, yeah, I don't want to get my annuity, you know, of $500 per month over 10 years anymore. I want my full amount. I want to, you know, terminate that contract. I want the full amount now. You can do that. Then we say you have to use this formula, which is X equal A minus D. X is the exempt portion. A is the amount originally paid for the annuity, and D is the total of the previously exempt portions to date. Now, guys, this is just some formulas that you need to study. We will never provide it to you in a test. You need to know them. We will look at an example now just to apply this little formula. Let's look at the first one. Mr. Bond purchased an annuity of $300 per month for himself, for which he paid an amount of $18,000. The annuity will be paid from 1 April 2020. Now guys, here I can already see that this is actually only 11 months, that 2021 year, and that is for 10 years. So obviously, let's look at the exempt portion. Y equals A over B times C. So lump sum, that one was easy. That is the 18,000, right? B is the expected return. So 300 times 12 months. There are 12 months in a year times 10 years. So we know the expected return will be 36,000 and C will be the 300 again. So 18,000 divided by 36 times 300. So the monthly exempt portion will be 150. But if you were supposed to calculate someone's tax or someone's income, the gross income will be, this person will receive 300 for 11 months, since it's only from the 1st of April. So 300 times 11, which is 3,300. The exempt portion will be 150 times 11 as well. So this will be exempted. So the income will be 3,300 minus 1650. So you remain with 1650. Let's look at another example on 1 October. So I always highlight my date because it's so important. Mrs. Nkosi, 55 years old, purchased an annuity of 500 per month for herself, for which she paid an amount of 120,000. The annuity will be paid for the rest of her life. Now, guys, we don't have the 10 years anymore, so that is removed. They now tell us for the rest of her life. Not a train smash. We just need to look in our prescribed textbook at the life expectancy table. Guys, how you look at it is you just find a female, because it's Mrs. Nkosi, 55 years, and it will give you a reading for how long someone who is 55 years, how long they will still be expected to live. However, in a test, guys, sometimes we don't give you the table, but I can give it to you. Like I said, you need to look at, is it male or female? How old is the person? And then you just read it from the table. However, in a test, sometimes we might just give you the life expectancy. So I will tell you in a test, Mrs. Nkosi, 55 years, the life expectancy of Mrs. Nkosi is 25.3, what is that? 349. They just use it like that. So Y was easy again. Y equals A over B times C. So A was easy, that is 120,000. B, expected returns, 500 per month, 12 months in a year. Life expectancy, 25.349. Very important, you cannot study this. This 25.359 is for a female, 55 years. In the test, I might give you a male, 55 years, and already it will be different. Now, can someone tell me why is the life expectancy different for males and females? Why do you think the life expectancy is different for males and females? The same age, let's say female 55, male 55, but it will be different. So tell me, just try. Why do you think? I'm waiting. Denver Gila, speak to us. Why do you think the life expectancy is different for females and males?
Statistics.
Yes?
Because
Yes, we are listening.
okay. Because statistically speaking,
You're speaking very, very softly.
can you hear me now?
Yes.
Because statistically speaking, men above the age of 55 are more likely to live longer due to health and due to how can I say life expectancy. I don't know how to put it, but
all right. Okay, I think I get what you're saying. So, but I have to say there's a lot of assumptions here. Is your theory proven? Why do you say men live longer who are older than 55? I would think you would say they live less or shorter.
statistically speaking,
Why? Where do you get your statistics? Remember when we say factually or statistically, you need to give me your source. Where did you find that? Because I'm trying to say it's not true. Anyway, let me give you the answer. So guys, even insurance companies such as Old Mutual, Sanlam, I debate with them. You know, when I enter into a policy, I don't just accept those terms and conditions. Let me give you an example. I took a funeral policy on my life and my parents' life a few years ago. And obviously, mom and dad needed to be added to this policy. So what I saw was, for me personally, the monthly amount was very low. And they told me it's because I'm a professional, I have a qualification and all of these things. And guys, those things actually count. It really counts in our favor if you, there's even another type of insurance called PPS, which is specifically only for professionals. So really it helps to be, there are in some cases where we are actually in an advantage position. So my amount, let's just say my amount was 38 Namibian dollars per month. They also said because I was still young that time, I'm not sure if I'm still young, but that time I was young. But then I saw with my mom and my dad, the installment was significantly different for mom and for dad. So I queried this, okay? Because first of all, my mom and my dad is 5 years. There's a 5 years gap, okay? So I asked the person, dad is obviously older, and then he told me, so dad's amount was much higher than that for my mom. I asked him, why is this the case? Because this looks to me like a type of discrimination in terms of installments. And the guy told me it's because men are more, we take more risks. He asked me questions like, what if there's a burglar and mom and dad is in the room? Who do you think will go check the door? Apparently it's the men. Who is the one that fixes the bulb? It's the men. And I did not agree with this because the roles have really changed over the years. Yes, I agree. That is probably one way to look at it. But to base your installments purely on that, I don't agree with that. And then obviously also just to actually refute Denver's claim that men over the age of 55 live longer. In fact, what he told me is they actually live shorter. In fact, in Namibia, men have a lower life expectancy than women, and it's because of our lifestyles. We are more risky. Also, Namibian roads will take care of you. Denver, please switch off your camera. So Namibian roads might, who is driving, if you look at accidents and all of this. So Denver, please switch off your camera. Anyway, so let's continue. So I'm just trying to give you how these people got to. So basically what they say is a woman 55 years old can still live 25.349. Now, if I say 25 plus 55, then they are actually saying Mrs. Nkosi's life expect, or the number of years that she will live is actually 80 years. Why? Currently she's 55. It is expected that she will still live another 25.349 years, which means that is how that life expectancy thing works. Let's go to the next one where we now look at A equals to, that one where we spoke about looking at what is your exemptions over the years. X equals to A minus D. So we know A is actually the amount originally paid. Then obviously you have to deduct your previous exemption. So guys, basically what the government says is, in previous years, I've given you exemptions. So now you need to basically, reverse that at the end of the day. So just to look at this quickly, guys, the final answer is 500 times 5. Why times 5? Because you only get it from October. So October, November, December, January, February. That is 5 months. 500 times 5, 2,500. Exempt portion, 394 times 5. Where did I get 394? From this calculation here. 120 is the purchase amount. 152 is the expected returns times the 500. So obviously you remain with 528 in that year of assessment. But let's look at X equals A minus D. So on 1 March 2018, M.E. Chaka purchased a 10-year annuity from ML Insurance Company. She paid 35,000. She received a monthly annuity of 350 every month from the end of March on 1 October 2020. Okay, so on 1 October 2020, Chaka terminated. Okay, so she doesn't want to get this 350 every month. She now wants to get a full amount. And she received a lump sum of 28,000. Now, guys, remember what does A minus D stand for? A is actually the amount originally paid. So sometimes you guys get this wrong and you think that is what I will get out if I terminate the contract. A is the amount originally paid, which in this case, A would be the 35,000 and not the 28,000. And then D is what was exempted over the years. So let's have a look at this. So guys, there are many ways to get to this answer. So what I did was I just said total expected receipts over the 10 years, remember? So actually, we expected her to get 350 times 10 years, which is 120 months, isn't it? 10 years times 12 months per year is 120 months. So what I'm saying is she would have actually got 42,000. That is the expected receipts. That is what she would have got at the end of the 10 years. That is the total amount. The capital portion from this 42, remember capital portion we say is actually, if you look at y equals a over b times c, this is actually what she paid. And if this is what you will get, then we are saying the capital portion would actually be 83.3%. That is what each receipt would have actually qualified for as an exemption. Okay? Therefore, now I can look at how much annuities did she receive to date, up to the point where she decided, I've had enough. I don't want to get 350 a month anymore. I want to get my full amount. Now, guys, obviously, if she received from 1 March 2018, then we can calculate that 1 March 2018 up to 30 September 2020. Why is it 30 September 2020? Because on the 1st of October, she actually terminated that contract. So you need to calculate up to that. Now, guys, if you calculate those months, you will get, actually, you will get 35 months from 1 March 2018 up to 30 September 2020. You will get 35 months. It's just 24 months. That's 2 years. So 1 March 2018 to 1 March 2019, that's 1 year. 1 March 2020, that's another year, so that's 24 months. And then from 1 March 2020 up to 30 September 2020, that is another 7 months. So that is 35 months. So the annuities that she actually received was 350 times 35 months. Oh, no, not 35, 24 plus 7. Sorry, 31 months. That gives you 10,850. So therefore, so since she received these annuities, and since I said the exempt portion is 83.3%, I could just say 10,850 times 83.3. So the exempt amount over 31 months, the capital portions was actually 9,042. So now if I put X minus, or actually X equals to A minus D. So A, that is the original amount paid. Remember, she paid 35,000. Everyone should at least get that mark. And then D is the exempt portions, what she received over the years, which is 9,042. Therefore, she will remain with 25,958. That is now the final exemption on this 28,000. So guys, let's put this in our tax framework. So the gross income for 2021, obviously guys, you still need to include the annuity received for those 7 months. Why am I saying 7 months? Because you still got it for 1 March up to 30 September 2020. So you still got your 350, right? For those 7 months. Then on 1 October, you decided, I want my full amount now, my lump sum. So include the 28. Now let's look what will be exempted. Obviously on this annuity, you could just say 245 times 0.833. You will see you will get 2042. So 2042 of that amount will still be exempted, or you could have also put it in our little formula, which is y equals to a over b times c. And now we want to look at what is the amount that will be exempted for this lump sum, and this is the amount that we just calculated here, 35 minus 9042, and we got 25958. Guys, that will be a good question in your next test again. So the income that remains is actually 2450. Now let's look at government grants. We say all grants received from the government, whether it is national, provincial, or even local, those will all be exempted for tax purposes. Now guys, we are done with exempt income. On Monday, we will look at this integrated example. Now guys, the solution is available for this very long example. Remember, next week we are supposed to look at a case study. So we will start with this one. What I tell students is, since you have the solution available, first try to do it on your own, this example. Then you check the solution, but we'll also discuss it in detail on Monday so that you actually understand. And remember guys, tax is a build-up subject, so some